Hello and welcome back. I'm Claudia Zeisberger, professor at INSEAD, and I look after private equity and venture capital. Today, we're going to have a closer look at private capital investing. In particular, why venture capital is not the same as buyout or growth equity investing. For short, PE is not VC. The private capital space is complicated, especially when you come with experience from the public market investment. So let me basically fly in the two columns, private equity, venture capital, and let's have a closer look at the two of them. What do private equity funds do? And when you have a look at their portfolio companies, they pretty much take existing companies from good to great in a 5 to 7 year time horizon. That means they will optimize the very successful ones. They will work very hard with the more modest successes and try to get them to a better performance. And they will try to reduce the losses in their portfolios. Now, venture capital is a complete different game. You're looking at the creation of new or better businesses. So you're working with very early stage companies, also often called startups, that are pre-product, pre-revenue, and for sure pre-profit. So what do you do as a venture capital fund? You really are in the business of finding outliers. I come again to the data in a second. You find outliers. The modest successes really don't count, because modest successes in venture capital usually mean even less than 1x, one time the money that you're investing. And you have to accept significantly higher loss rates, up to 50% of the funds invested. So private equity is really about optimization, whilst venture capital is about creation. And this comes with very different risk appetite that is required by the investors. So PE, private equity, makes 2/3 of its returns from 57% of its investments within 1 to 5x. In venture capital, it's all a bet of outliers. You're looking for those moonshots, those companies that will change a category, change the world, game changers. So it's a bet of outliers with half of the returns made from only 4% of your investments. So basically, for all of you interested in statistics, it's a power law. Now, a little bit deeper into that data, as I promised. So let's start off with venture capital. On the left-hand side, 50% of your investments will fail. Then you see at the bottom, your money back, basically, 1.06x. What do I mean by that? The investors that invested in the venture capital fund are getting at a minimum the money back that they are investing in the fund. No returns yet, just money back. So the 0 to 1x, 1 to 5x, 5 to 10x, basically, you see that on the bottom is the multiple that you are returning as a VC to your investors per investments. I'll come to the data in a second. And on the far right side, you see the big winners. More than 10x, more than 10 times your money returned. Meaning you make half your returns as a venture capital fund from 4% of your investee companies. As a fund, when you look across your portfolio, and let's assume you're targeting a 2 times return back, that would mean that 1x comes back from 4% of your investments, and the other 1.06x come back from your 0 to 5 to 10 times returns on your investments. So as you can see, you need a real stomach for loss-making investments. Now, let's jump on to private equity. Here, this is a very different game. Private equity makes 2/3 of its returns from 57% of investments. Those investments usually are somewhere between 1x and 5x. As you can see, the big bar, the purple bar in the middle, that's where your big winners are sitting, right? So on a fund formation part, for VC, we just talked about that. For private equity, to get to a 2x, it is a much more dispersed conversation, okay? As you see on the left-hand side, contrary to venture capital, only about 8% of companies fail completely. That means all the other companies are contributing to your return to some extent. So 29% comes from those that are somehow returning anything from 0 to 1x. Then you have obviously the big column in the middle, 1 to 5x, that makes up about 57% of your investments returns. And the 6% basically on the right side will of course add in a meaningful way to your returns, but you are not betting on outliers. So in buyout and growth funds, you are really focusing on optimizing your whole portfolio and of course keeping your losses low, but the losses are really single digits. So if I walk through this as a final slide, private equity on the left-hand side versus venture on the right-hand side. You invest in companies versus investing in ideas on the venture side. Private equity, taking companies from good to great, whilst venture capital, creating new businesses. So investing in established companies versus investing in startups, in founders with new ideas, with a high level of uncertainty for the future. Well-established market testing products, that's what you're looking at on the left-hand side. You usually have companies with positive cash flow. Obviously, what you want is a positive and stable cash flow, so you can potentially even add some leverage to the balance sheet of that company. You have historical statements, financial statements, you have data that you can look at, and you have a very clear, often very predictable trajectory for your growth on the growth equity side. Whilst on the right-hand side, looking at VC, often you may start off without any product. Like I mentioned, pre-product startups. So more often than not, no revenue, and certainly no profit. So cash flow are few and far in between. Now, audit, there was no history, hence we can't have any audited history, right? So very rapid growth is expected. Like I said, we're looking for that moonshot. We're looking at extreme outliers. Now, from a return expectation, you expected to deliver at least a 10x to your investors. So you're looking for those startups that can deliver a very, very high return in 3 to 5 years. Why? Those winners have to make up for the large amount of losers. If you want a rule of thumb in VC, in early stage VC, we usually say 8 out of 10 companies will not return 1x. That's a pretty good rule of thumb. On the PE side, individual companies, portfolio companies, delivering a 2x return is plenty. Why? Because we have such a low failure rate. Those winners don't have to make up for the ones that failed. So clearly, private equity, significantly lower risk, whilst venture capital, a significantly higher risk bucket for all the investors in those funds. So on that note, I hope this lecture was useful for you, and I look forward for you to coming back to subsequent lectures. We're going to dive deeper into those conversations. Thank you very much.